Let's talk about something most traders struggle with, especially during high volatility or all-time high environments: positioning yourself for trades properly and knowing when not to trade. Everyone loves the idea of being an active trader, taking setups every single day, staying in the market consistently, and always doing something. But the truth is, the best traders aren't the most active. They're the most disciplined. In this video, I'm going to break down how to position yourself correctly and how to recognize when it's time to sit out and avoid forcing trades just to feel busy. If you find value in this, make sure you leave a like, subscribe, and let's get into it. So as you can see, price action from October 10th all the way to October 26th, there's been only one trade for me. And why is this? Because I waited for proper market structure to form, the macro edge to tell me when to trade and when not to trade. And as you can see, after that, I have not taken any trades. One of the biggest traps in trading is the need to be constantly involved. When we see the market moving, we think if I'm not trading, I'm missing out. When you're forcing trades, what you're really doing is trying to create an opportunity where there isn't any structure. You're not following your edge anymore, you're just following emotion. And here's the truth: when there's no clear market structure, no clean zones or setups, your edge doesn't exist. You're just guessing. And guessing in the markets burns and blows accounts. I was very patient with the setup. This took 13 days to form and was only a 3-day executed trade. I did not touch this until proper structure built after this massive sell-off due to the tariffs. Once confirming my market structure bias and my macro edge, it was very easy for me to take a position like this where I saw minimal drawdown and a very clean entry. Nothing is more satisfying as a trader than waiting for a proper setup, having the perfect execution, and just watching your trade go straight to TP with no issues at all. When structure finally starts forming, that's when your positioning matters the most. You don't want to chase these candles. You want to position yourself around the key levels. This means identifying your higher time frame zones, wait for retests or confirmations, and scale in at structure points where risk is defined, not in the middle of moves. Trading isn't about predicting tops and bottoms. It's about reacting to structure that's already been built. Let's look at another example in this case. I've been waiting to take more gold longs back to all-time highs after seeing that we've failed to break them. We've tested it on multiple occasions, but in reality, we've just gone much lower. This is an area in which I was very interested, where we were forming a range, and if we had a breakout of price above this level, I would start looking for more longs. I was very patient based on the macro sentiment and the market structure, and as you can see, if I was taking a position from here, I would have lost a lot of money. Again, for me, this is about knowing when to set out of the markets. If the market is showing me ranging price action and more of a breakout towards the lows, that does not signal me that I want to be continuing to trade to the upside. Yes, I only trade higher time frame, but the read on this is very clear. Failing to make higher highs, continuously making lower lows, to any trader, that just means we are in a bearish market structure. On the macro side of things, we are still in the midst of a government shutdown. The stock market is ripping to all-time highs. Gold was previously at all-time highs. We have rate cuts coming in. The housing market is at all-time highs. For gold, this isn't exactly amazing news. I was very bullish on gold, as I made in a past video, and I did foresee a gradual increase in gold prices, but as you can see, we have trailed off. Now, I'm not biting my tongue and saying, oh my gosh, I was so wrong. But at the same time, there is an element of, okay, why was I wrong? I take a look at the macro, and now I'm starting to understand why gold is trending downwards. Now, to me, I can start looking for setups to the downside, or I can continue waiting for the proper market structure to show me that I should be trading back to the upside. Over trading doesn't just mean too many trades. It means too much exposure. For me, this is why I stay mostly in cash when I don't see opportunities. I want my liquidity. I don't want to be fully invested in a market that's stretched or uncertain. If I'm trying to enter a trade based on this market structure, you can see how quickly this would have gone against me. We didn't even break the range high to be taking any position to the upside. We could have taken a range breakout off the lows, but I don't foresee that doing much since we have very low volume and like smaller candles as well. Jumping back to the NASDAQ, this is where it's completely clear to me that I need to not touch anything related to indices. Right now, we have no structure to the left. We are floating in literally thin air. As you can see here, we have market structure confirming to me that we can trade to the upside and into that bit of unknown. But as you can see, from those all-time highs, we're not stretched very far. In regards to up here, this is a structure point where I kind of marked out, but it's really nothing special. This is like trying to walk on a ground that has no floor. Uncertain, it's uneven, and it's just something you don't want to be wasting your time with. Considering that we're just floating up into thin air as well, how am I supposed to take anything based on market structure? I would just be buying thin air, and then I would be selling into uncertainty. Even on the stock side of things, it's the same logic. I'm not buying companies because I like them. I'm waiting for discounts. I'm waiting for pullbacks to structure where I can get value, not the hype. If we take a look at Tesla, I had a big position down around the 411 mark, and look how that paid off. I'm up around 13% from my entry on this position, and I'm very happy with that. Why? Because I waited for that discount in price. You're not going to catch me buying at these overstretched highs. I'm waiting for that pullback before jumping in and scaling my position to the upside. Obviously, the same patience translates directly into my trading. Fewer high quality setups, better RR, and just less stress. I would much rather take a for sure position where I can say I lost, but I was very confident in the move, rather than taking a trade that is completely uncertain, where I would be saying, wow, I shouldn't have taken that trade. That was clearly going the opposite way in hindsight. When the market is giving you structure and clarity, you can clearly see your directional bias, volume supporting that move, and levels where risk is well defined. And in a case like this is where you execute, because you're following your confirmation, not your emotions. At the end of the day, trading is a waiting game. Most of your time should be spent preparing for the trade, not in the trade. Again, this trade took 13 days to form for me and only had a 3-day execution. When you position yourself properly, stay liquid, follow structure, and stop trying to force what isn't there, that is when you become a truly disciplined trader and learn to let the market present the opportunities to you. That's how you protect your capital, your mindset, and your longevity as a trader. If you guys found this video helpful, make sure to drop a like, drop a comment with any questions you have, and subscribe, and we'll see you in the next one.